Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Before we get into the more specifics of the relationship, just wanted to show you what the current policy is in China. China's the yuan or the renminbi, they're used interchangeably, same currency. It's pegged to the dollar, and it's in what's called a crawling peg currency regime. And this started in July 2005. Before that, the currency was directly pegged to the dollar and didn't change, but now it's pegged to the dollar in what's called a crawling peg currency, meaning it's allowed to appreciate and fluctuate 0.3% per day around the dollar. They say it's based on a basket of currencies, but we're not quite sure what this basket is. When they initially went to a crawling peg system and started to allow their currency to appreciate, the first day they started this, it appreciated 2.1% in one day. So we've seen some appreciation in the currency, but not much. Crawling peg basically allows them to manipulate and keep it where they want it. That's what it does. They refer to this as a dirty float regime, but it's not a dirty float regime at all. A dirty float regime the currency would appreciate and be much more volatile. It's a crawling peg that's controlled by China themselves, and they control what this basket is, this nebulous basket. So it really is a completely controlled currency of the world. Is the currency undervalued? My question is there any doubt that it's undervalued? Most economists place an undervaluation from 20 to 50%. Some say it's even higher. There are reasons, given what's happening to their export market and growth, to suggest maybe it might be a little lower than that 20%. You usually hear the cheerleaders for China say that China's currency is fairly valued, and the currency really has nothing to do with the problems in the world. I don't necessarily think that's true. I think we attach too much to the currency in terms of the potential problems in the world and the potential trade competitiveness between the U.S. and China. But in general, it's significantly undervalued. And let me just give you an example, just some basic examples of that. This is the Chinese currency compared to the U.S. dollar, this chart right here on the left. Going back to 1980, you can see how it's depreciated in here. 1990. So if we start from the year 2000, it was pegged, and here's that 2005 when it started to go in to the dirty float, so to speak. Let me grab a pencil instead of a pen here. This is looking nasty. Here we go. When we started the, not dirty float, the crawling peg, which was allowed to appreciate. Now this is an example, and over here, going from 2000 on, this is their GDP growth, just growth in GDP, and you can see how fast the economy has grown, and you compound that up, you can see how far China has come in a short period of time. So if you compare just from 2000 on, the incredible growth in China's GDP, and then you look at the currency, that in and of itself tells you that something isn't right here. Currencies appreciated 21% against the U.S. dollar since 2000. Taking one of the BRICS, even the Brazilian real. If we look at where the Brazilian real bottomed against the U.S. dollar in 2002, it's just kind of a thumbnail example of the differences. How the real has gone up 89% against the U.S. dollar in 2002, and China's gone up 21%. Again, it's just, there's no doubt, I think, any way you look at this, that the Chinese currency is significantly undervalued, and there's a reason for that. They suppress their currency because they're highly geared to the export model. China is an export country. Its jobs are tied to exports. Its policy is tied to driving money and keeping money inside the country in order to create more capacity for exports. It is the manufacturing hub of the world, and it must export. And I'll get to an example of how they do their forced savings to create more capital to build this export model. And their continued focus on an export model right now in a world where global demand has fallen off the cliff is already starting to create some major tensions in the world, and really could be a real problem out there, and that's the risk, I think, of their entire policy, and we'll get to examine a little bit of that in a second. Their other major concern about letting their currency appreciate is what happened to Japan. And there was something called the Plaza Accord, and it happened back in 1985. The Plaza Accord, the G7 and the major industrialized countries of the world at that time got together and said that the U.S. dollar was too high and they needed to push down the dollar. So the major central banks of the world intervened to push down the value of the dollar. Well, implicitly in the Plaza Accord, they were really concerned because the value of the yen was too low. The Japanese yen at the time, as we all know, was taking over the world in the mid-1980s. Their currency at the time, as you can see, was about 260 yen to the dollar in here. The Plaza Accord was designed to push the yen down, and it worked, as you can see, or at least push the value of the yen up. So as dollar yen fell, which means it takes fewer and fewer yen to buy $1, it means the yen appreciated in value tremendously. It worked. The Plaza Accord worked. China looks at, and as we know, once their currency came down, they lost some export competitiveness, but some other things were happening in the world, and we'll get to that. China looks at this and says, okay, they pushed the value of the currency down. Sure enough, Japan went into a major bear market. Their stock market broke here. Their real estate market broke, and then they had an entire decade in the doldrums. China is very much afraid of this same thing. That's another reason they're fighting this appreciation of their currency. And people that believe there was going to be this massive one-off revaluation in the Chinese currency really weren't paying attention to some of this. We didn't see it. And one of the questions as I got on is when the gentleman, Mr. King, had asked, is China going to float their currency anytime soon? And my answer is, I really don't think so. It would be a real big surprise given where they are and given their concern about this in the background. It also goes back further to something called the silver policy in the 1930s, where the U.S. did something in terms of moving the gold to, and basically hurt China in a very, very big way. So they have some institutional memory on these policies put together that they see as hurting them in particular because of their trade competitiveness. So that's another reason they fight this revaluation of their currency. But ultimately we think it's a bad thing for them and hurting them. Here's why. If you have a sustained undervaluation of the renminbi, which is the yuan, used in capital controls, which they have on, you have to understand that Chinese companies and individual investors are not able just to freely take money that they get from the West and invest it outward wherever they choose. They're forced to really put that right back into the People's Bank of China. That's really their only choice, and those are the capital controls. So when you have a sustained undervaluation of the currency and capital controls, it tends to drive, and because of the growth that it's created in terms of their infrastructure investment, tends to drive a lot of foreign direct investment into the country, which is what they want. They need liquidity externally to continue to grow. A lot of hot money investment comes in, as I said, thinking there will be some type of one-off revaluation, and that's driven a lot of hot money. A lot of that hot money has left China now, and they've lost a lot of liquidity because of the credit crunch. But prior to that, that was a big belief. Hey, if I get some money invested in China, whether it's in some type of real estate or whatever program there is, and they revalue by 20, 40, 50% right off the bat, boom, my asset goes up by that. China, again, one of the problems they see, if they were to do a one-off revaluation with this hot money, the hot money would run back out. So this undervaluation is part of this scenario. Obviously, the undervaluation creates a massive trade surplus. When your currency is 50% undervalued relative to your competitor, you're going to tend to sell a lot more goods, and that's part of it, and that's part of that driver of the trade surplus, which they're very, very happy with.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.